Hello everyone, welcome to today's US Open live session. It is Tuesday, March the 5th, 10 minutes before Wall Street opens. As always, I am your host, Nikos Zabouras, Senior Financial Editorial Writer at FXCM. Commodities are in the spotlight this week and will be in today's session as we had OPEC Plus extending its output cuts. We also have gold surging, and we have interesting developments and price action around natural gas as well. And of course, we have high impact events coming up over the following days with Fed Chair Powell testifying in Congress, and of course, the monetary policy decision by the European Central Bank. That's what we will be talking about today. But before we begin, as always, please read carefully through the risk warnings and the disclaimers. Once again, please go over the risk warnings and disclaimers carefully, and please bear in mind that anything discussed in this session does not constitute investment advice and should not be construed as such. Having said that, let's dive right into it. And of course, if there are any opinions and comments or questions around the themes we discuss, please feel free to type them in the chat box so that we can address them. We are going to start off with Euro USD and the Nasdaq 100, get the latest technical update, and also discuss about high impact events that are coming up, mostly with Fed Chair Powell and the European Central Bank's monetary policy decision. And then we're gonna focus on commodities, and we have interesting developments and price action for oil prices, for natural gas prices, and of course gold's surge over the past few days. Now on the Euro USD front, as you can see on the 4-hour chart, it continues the consolidation at critical technical levels following its recent rebound. It's reasonable for the pair to show indecision given the murky policy differential and, as we said, the incoming critical event. The pair stays above the 200 period exponential moving average, the black line that you see on the chart, and this gives a slight upward bias and brings 1.1017 resistance in the spotlight. However, this is still distant, and a strong catalyst would be needed for the common currency to challenge that. And in any case, as we've said before, the immediate upside is unfriendly. And you can see, of course, a falling daily Ichimoku cloud, a thick daily Ichimoku cloud that can constrain any advances. The common currency, however, we can see that despite this recent rebound, it fails to clear the 38.2% Fibonacci of its last leg down, and that creates scope for a return back towards the February lows at 1.0694. However, sustained weakness past that level definitely has a high degree of difficulty. Of course, the next leg of the move will be determined by high impact events that are coming up. Fed Chair Powell testifies on Wednesday and Thursday in front of Congress. and this comes just a couple of days before the communication blackout period begins. The Fed has pointed to the end of tightening and 3 rate cuts this year, but has turned cautious given an overperforming economy, a strong labor market, and some inflation persistence. As such, Chair Powell could lean hawkish, but maybe markets have already priced that in. Now, we also expect the European Central Bank on Tuesday. It had hinted at peak rates, and has been some talk for some rate cuts. Inflation has decelerated sharply over recent months, and the economy is struggling, making the ECB a better candidate for a pivot than its US counterpart. But officials have adopted a more hawkish rhetoric compared to the Fed, and President Lagarde in the previous meeting had called any discussion of cut premature. So definitely we will be waiting to see if there is a shift in the ECB's rhetoric and whether it will start embracing rate cuts or will maintain this hawkish stance. Now let's go to the Nasdaq 100. We're still 4 minutes out of the US Open. The tech-heavy index slips, as we can see, after last week's surge, and of course after setting new record highs. That surge and those highs were fueled by continued AI optimism and good enough, I would say, PC inflation figures. Of course, artificial intelligence is the main driving force of the 2023-2024 rally. And last week we got the earnings report from a not so well-known AI company, but at the forefront of this technology, which is C3 AI. And its results help sustain the bullish sentiment. It's an enterprise AI application software startup, which posted strong results and outlook. Now, on the PC inflation front, as we said, that appeared to be good enough for markets at 2.4% year over year for the headline and 2.8% year over year for the core, which was the slowest growth in nearly 2 years. Now, given those new record highs and the continuous strength, Nasdaq 100 now looks towards the 19K handle. However, the inflation figures we just referenced marked only a small deceleration year over year and actually rose on a monthly basis. Furthermore, markets may not be able to overlook the Fed's reserved approach for long, and of course, Chair Powell's testimony could affect that. We can, as we said, the index slips this week, and we could see another test of the 200 period DMA, the black line that you see on the 4-hour chart, located at around 17,630, but sustained weakness below 17,322. The February lows will need significant change in sentiment, and even below that we have the rising daily Ichimoku cloud. And now let's switch gears and turn our attention to commodities, as we have interesting developments and price action on oil, natural gas, and gold. And let's start with oil, and also tie this with China's economic targets, which we got today. Of course, if there are any opinions or questions, feel free to type them in the chat box so that we can address them. So we have US oil here on the 4-hour chart. OPEC Plus extended it has been implementing additional cuts of 2.2 million barrels per day for the first quarter, and on Sunday it announced an extension of those additional cuts until mid-year, until the end of Q2, maintaining the total output curve at nearly 5.9 million barrels per day. Oil prices had already risen last week in anticipation of the action. You can see how they reached last week new 2024 highs. And these are substantial restrictions which can help extend gains. And of course, don't forget that these come on top of the war in the Middle East that can cause supply disruptions. However, we are still cautious around gains that would tackle the next major level at 84.90. Despite, I need to say though, I think I've said this before via this venue, supply constraints are a less potent upward driver for oil prices compared to demand creation, and things are not as encouraging around the latter. Today, the world's second largest consumer and bigger importer, China, set a target of around 5% for GDP growth in 2024, and it's economic, but this may be hard to achieve. And furthermore, officials lowered their budget deficit to 3% from 3.8% previously, which implies that big stimulus will remain elusive. And of course, in order to spur consumer demand and more robust economic growth in general, which has been sluggish, officials may need to act more boldly, and this has not happened so far. And given this budget target, they may not do that now either, this year either. So that would be bad for consumption, for oil consumption. Furthermore, the International Energy Agency expects global oil demand growth to nearly half this year, to 1.2 million barrels per day, and supply to be eclipsed by increased production by non-OPEC members, by non-OPEC countries. As a result, the commodity slides today, and as you can see, it struggles once again to stay above the 38.2% Fibonacci, which raises risk for sub 200 period EMA moves, which is around 76.18. And this would shift bias to the downside and bring the February lows in the spotlight at 71.38. However, strong catalyst will be required for a test, and you can see that until that level, the February low, there are multiple support areas provided by the daily Ichimoku cloud and the ascending trend line from the December lows, as you can see on the 4-hour chart. Now let's move over to natural gas. It rises from its nearly 4-month lows amidst better prospects around supply and around the supply and demand equilibrium. Major US drillers have slashed their output goals for 2024, such as Chesapeake and EQT, with the latter also announcing this week a production cut of 1 billion cubic feet per day through the end of March. Furthermore, the International Energy Agency expects demand to grow by 2.5% this year, a significant acceleration compared to the 0.5% increase in 2023. Natural gas now tries to take out a pivotal resistance area defined by the 23.6 Fibonacci level and the 200 period EMA, which could send it towards the 38.2% Fibo, but does not inspire yet much confidence for stronger recovery. On the other hand, the agency expects supply growth of 3.5%, which is more than its projections for demand growth. And we've seen so far, we had a very warm 2023, and 24 has also started with very warm weather, the hottest January on record, and that could sap demand for natural gas. As long as 0.2% Fibonacci, there would still be scope for new lower lows, which are located at 1.5235. And let's round things off with gold. It comes from its best week of the year and extend its gains during the current week, trying to surpass the December record highs. You can see here it's close to doing that. There doesn't seem to be just one factor, but various, perhaps less important ones. India demand is one, some flight to safety due to geopolitical tension, and of course, prospects of Fed easing. Technically, however, of course, the next major resistance comes at around 2,180, but a look at the relative strength index points to overbought conditions. In fact, the most overbought since the previous record high. As such, we could see a pullback potentially below the 2008 support, but it's hard at this point to see moves below the daily Ichimoku cloud and the exponential moving average. That's pretty much it from me for today. We will talk again on Thursday with the outcome of the first speech by Chair Powell and the ECB policy decision. That's it from me. Thank you for joining me.